Episode number 8. So, I kind of want to talk about now options trading. Now, this is a thing that I've learned, and it's something that a lot of people who are especially are beginners see online and see it as a way to make a quick buck. And it is a very easy way to, get a ton of money extremely quick, but it's also an extremely easy way to lose a ton of money extremely quick. Now, when I first had researched this, it was honestly initially pretty confusing. It sounded extremely complicated, kind of fast paced, and pretty intimidating as well to me. But at the same time, it's often presented online as a way to make money quickly, and I was kind of like, I'd rather just would know what this is about, even if it's not just making money quickly, but it's just a good thing to know, right? And so on top of that, I wanted to understand it more carefully, why people were saying it's a way to quickly lose or gain money. So basically, there are two kinds of options tradings that you can do. There are calls and there are puts. So a call option gives you the right to buy a stock at a set price, whereas a put option gives you the right to sell the stock at a set price as well. So instead of actually buying the stock itself, you're buying the possibility of making a decision later. And that depends on how the price actually moves. And that's where things start to get kind of interesting, because options allow you potentially to make money, not just when the stock goes up, but also when the stock is going down. But here's the part that I didn't fully understand at first, and it was the fact that option trading can induce a lot of risk, because you can actually lose more money than you have put in. You can actually owe money. And another thing is that options trading allows you to make money on the downhill while a stock is going down, which is something I had never heard of, because I had always heard of buy low and sell high. Buy a stock at the lowest possible price and then sell it at the highest possible price. But if you buy a put option, that allows you to make money while the stock is going down. And they're just now thinking of a perfect example of this. During the 2008 housing crisis, a lot of people were losing a ton of money. But there's a very famous example of a man who made a ton of money while the stock market was completely crashing during the housing crisis. And essentially what he did was put a put on the entire market with the intention that he thought that the market would completely go down, and that's exactly what happened. He put a several $billion short on or put option on a stock, or not on a stock, but on several stocks, and that ended up happening. And so he made a lot of money off of that. Now, obviously, we can't all make those big decisions all the time, but I think it's good to start to understand how these things work. Okay, so I think at its core, another thing I kind of want to go over is that when you buy an option, there's an expiration date. If the price doesn't move the way you expected it to move before that date, if the price doesn't move the way you expected before that date, the option can expire and be completely worthless, which means you will lose the entire amount that you had put in. Now, this is extremely different from long-term investing, and I suggest that if you're a beginner investor, it's not a wise way of getting involved in investing. I think it's something you have to heavily research and heavily understand how you are doing, how it works, and what you can do. And it's extremely complex, again, because it's also influenced by volatility and other factors and whatnot. So even if you're right about the direction of a stock, even if it goes up and it doesn't hit the set price that you wanted it to hit, you can still lose all your money, just depending on the timing, right? So for example, if you are predicting that a stock will go up and hit a certain price marker, let's say $100 per share, but And so you end up buying a contract, right, for $100 or not for $100, but a contract saying that the price will hit $100. But over the course of time, after your contract expires, the price did not hit that $100 mark. It hit like $99.999, right? You will still lose all of your money, which that is the reason why it becomes incredibly risky, and why a lot of it is based on the timing. I think also options trading can lead you to make very impulsive decisions that again ties into the psychological aspect of things. And I think as a beginner, it's very important that you understand what you're getting involved in and being able to manage the risk and develop a discipline for how you choose to invest. Yeah.